When people ask me what kind of investment portfolio beats most investors, they often expect some kind of secret allocation. They expect a clever combination of stocks, a hidden fund, a piece of insider logic, or some kind of tactical strategy that quietly outperforms everyone else. But the truth is very different. Today, I want to walk you through the portfolio structure that, in my experience, generates long-term financial independence far more reliably than trying to predict the next big thing. And at the end of the video, I'll show you how to get a free video review from us so you can start actually building this portfolio for yourself. Hi, I'm Josh Palmer, Director of Financial Planning for the Noble Group. I'm a certified financial planner with over 25 years of experience in the financial services industry. Before I break down how this kind of portfolio works, I first have to make something clear. Most investors underperform not because their investments are bad, but because their behavior is unstable. They buy too late. They sell too early. They drift between strategies depending on what they see online or hear from friends. They treat investing like a series of reactions instead of a long-term plan. And even the best portfolio in the world cannot save someone from emotional decision making. So when I talk about a portfolio that beats most investors, what I'm actually talking about is a portfolio that safeguards its owner from the impulses that ruin returns. In other words, this portfolio is designed not only to work mathematically, but to also work psychologically. So the foundation of a truly effective portfolio is broad global diversification. That means you're not trying to pick individual winners. You're not attaching your future to one company, one sector, or one story. You're owning slices of thousands of companies across the United States, international markets, and emerging economies. The reason this works is simple. The global economy is always evolving, and different parts of the world grow at different times. When you spread your investments across that global landscape, you allow yourself to participate in long-term growth potential without betting on specific outcomes. Wealthy investors understand that markets do not reward prediction. Instead, they reward participation. And the more broadly you participate, the more consistent your long-term results can become. Within that global foundation, a portfolio that consistently beats emotional investors also emphasizes asset classes that complement each other. Equities drive growth, but they are volatile. Bonds are less volatile and provide income. Real estate adds diversification and seeks to provide inflation protection. Alternatives, used appropriately, can provide non-correlated returns that manage risk over long periods. But the exact percentage of each category depends on something very personal, your goals. And this is where the conversation shifts from theory to practice. Because the portfolio that beats most investors is not the portfolio with the highest possible growth. It's the portfolio that aligns most closely with the investor's life, risk tolerance, timeline, and emotional behavior. Let me give you an example. Suppose two investors have identical portfolios with an average return of 7% over time. One investor panics during downturns, sells when the market dips, and buys back after prices recover. The other investor stays consistent and rides through the volatility. They are invested in the same assets. They start at the same time. They earn the same average long-term return. But the investor who stays consistent ends up dramatically wealthier. The difference is behavior, not allocation. And the right portfolio structure is one that makes it easier to behave well. That means a portfolio that fits your risk tolerance so closely that you are not tempted to abandon it during stressful moments. This brings me to the most misunderstood element of portfolio design: risk. Most people imagine risk as something to avoid or something that only matters when bad events happen. Risk is not the enemy. Misaligned risk is. The right amount of risk is what allows your portfolio to grow. Too little risk and your money fails to outpace inflation or reach your long-term goals. Too much risk and your emotional reactions undermine your returns. Wealthy investors understand that risk is not a danger to be avoided, but a tool to be calibrated. They select a risk level that allows them to stay invested no matter what the market does. And once that calibration is correct, the portfolio becomes a quiet engine of long-term growth potential. So what does this look like in practice? Well, a portfolio that beats most investors typically starts with a strong core of broad, low-cost index funds or ETFs. These funds provide exposure to entire markets in a way that dramatically reduces the risk of picking wrong. Index funds remove ego from the equation. They eliminate the idea that you need to find the next Apple or Amazon to succeed. Instead, they allow you to own the entire ecosystem of global innovation and productivity. When markets rise, you rise with them. When individuals individual companies fall, they barely register. It's a structure built for permanence, not prediction. Layered on top of that core, a well-structured portfolio adds high-quality bonds. These bonds act as shock absorbers during volatile periods. Their purpose is not to maximize growth, but to reduce the emotional impact of downturns. When your portfolio declines less during market turbulence, you are far less likely to panic. This is where people underestimate the value of fixed income. They see bonds as boring, when in reality they are behavioral insurance. They help keep you invested long enough for your growth assets to do their job. And staying invested is the single most important contributor to long-term performance. The next defining characteristic of a strong portfolio is that it is simple. Simplicity is not a lack of sophistication. It's a lack of unnecessary complexity. Wealthy investors do not create complicated portfolios because complicated portfolios are harder to manage, harder to understand, and harder to stay committed to. Simplicity creates clarity. Clarity creates consistency, and consistency creates wealth. I have seen countless investors chase complicated strategies because they believe complexity equals intelligence. But the most powerful portfolios tend to be the ones that are easy to follow and easy to maintain. But maintaining your portfolio means it'll periodically need rebalancing. Rebalancing is simply the process of adjusting your portfolio back to its original target allocation. When stocks have a strong year, their portion of your portfolio grows and may exceed your target. Rebalancing brings that allocation back down by shifting some gains into other asset classes like bonds or real estate. When stocks decline, rebalancing shifts money into them at lower prices. It is a systematic way of buying low and selling high without relying on emotion or timing instincts. Rebalancing is what keeps your risk level consistent, and consistent risk equals consistent behavior. Investors who rebalance regularly tend to outperform investors who let their portfolio drift based on the market movements. Next, you have to have a handle on cost control. Fees matter. They matter more than most people realize. A 1% fee might sound small, but over decades it can erode hundreds of thousands of dollars from your portfolio. Wealthy investors pay attention to fees because they understand their impact on compounding. Low-cost index funds, tax-efficient strategies, and careful investment selection are how you maximize what you keep. You cannot control the market, but you can control fees. And the investors who control costs tend to outperform those who do not. Now, not all fees are bad. In fact, some fees, like a financial planning fee, can be a worthwhile investment over the long run. My colleague Jared broke down a study that showed the math of hiring a financial advisor. And in the end, it illustrated that working with an advisor can result in added value far beyond the fee they charge. Click here to watch. Now, another question that comes up very frequently is whether a portfolio should include real estate. The answer depends on the investor. On one side, real estate can be a powerful source of diversification and income. It behaves differently than stocks and bonds, which means it aims to stabilize long-term returns. But real estate also requires management, maintenance, and the understanding of the local market. Wealthy investors tend to include real estate when it aligns with their expertise or their long-term cash flow goals. It's a part of the broader philosophy that the best portfolio is one that matches your life, not someone else's. At this point, let's take a step back, because I want to emphasize that the portfolio I am describing is not designed to beat the market. It's designed to beat most investors. And these are two very different goals. Beating the market requires prediction, timing, and a willingness to take risks that most people cannot emotionally handle. Beating most investors requires something much simpler: avoiding emotional mistakes, staying diversified, keeping costs low, and maintaining a clear strategy. The investors who behave well strive to outperform the investors who behave emotionally, even when their portfolios look almost identical on paper. This is where emotion becomes incredibly important. Don't base your portfolio success on short-term performance. If you look at how wealthy individuals measure the success of their own portfolios, you won't find them comparing this year's return to last year's. They are measuring progress towards long-term goals. If their portfolio grows at a steady rate and moves them closer to financial independence, they consider that a success. If the portfolio experiences a temporary decline, but the strategy is sound, they stay patient. They do not chase flashy investments. They do not panic during downturns. They play the long game because they understand that long-term consistency beats short-term intensity, and you need to do the same. The final piece of a portfolio that beats most investors is one that fits seamlessly into the rest of your financial life. It aligns with your income, your tax plan, your estate plan, your insurance coverage, and your long-term vision. It is not isolated, it's integrated. Wealthy individuals do not build portfolios in a vacuum. They build portfolios inside a broader plan. And when everything is aligned, your goals, your risk level, your cash flow, your taxes, and your investments, the result is a sense of clarity that most investors never experience. So when people ask me to describe the portfolio that beats most investors, I tell them it's not about finding something extraordinary, it's about avoiding the ordinary mistakes that most investors make. It's about structure, simplicity, consistency, and discipline. It's about building a portfolio you understand well enough to trust, and it's about designing a strategy you can stick with, not just when times are good, but when they are challenging. Because a portfolio you can actually stay committed to is preferable to one you will abandon. And we're here to help you build that portfolio you can stay committed to. Click the link in the description or scan the QR code on screen to receive a free video review from us so you can see where you stand and the path you can take to pursue your financial goals. Thanks for watching.